What does it mean when Nvidia pours $100 billion into OpenAI, which is the biggest bet yet on artificial intelligence? Well, let me tell you, it's this turning point. It's a turning point for markets, and it's exactly why stocks are sitting at fresh record highs right now. But is this a warning sign or is this just noise? So we're going to talk about that today because the answers matter for where markets are headed next. So here's what went down today. We've seen all three indices hit new records yet again. The Dow up 0.14%, the S&P 500 up 0.44%, the Nasdaq up 0.7%. So the tech and the AI plays, those are your winners. And the driver here was Nvidia. So they announced this massive partnership with OpenAI. And when I say massive, I mean $100 billion massive. So Nvidia is basically saying we're going to help OpenAI build out enough AI computing power to run the next generation of supermodels. We're talking 10 gigawatts of Nvidia systems, which is about the same amount of power as 4 Hoover dams, or enough energy to light 8 million homes. Woo! So it's infrastructure on a scale that sounds almost unreal, and investors really loved it. We've seen Nvidia pop, we've seen the indices follow, and the AI trade looks stronger than ever. And it's almost seemed that Nvidia is locking in these record highs for the stock market because you're starting to see Nvidia make this investment into all of these other companies, and it's almost like they're saying, hey, wait, the AI narrative isn't over with, y'all. We still got room to run. But, I mean, aside all of that, let's zoom out and talk about what else matters other than AI hype, which it's also about interest rates right now. So right now, markets are betting that the Fed funds rate will drop to just under 3% by the end of next year, compared to a little over 4% today, which is a big deal because cheaper borrowing means everything from mortgages to corporate debt. It all gets easier to manage, and it fuels more spending and investing. Now remember that last part, it fuels more spending and investing. Now let's kind of trace back a little bit, because now everybody's wondering, like, wait, this guy doesn't know what he's talking about, because mortgages and most of corporate rates follow the 10-year treasury yield in these longer term bonds. You are right, but to an extent the Fed does have cover to where they influence the market's inflation expectations, which drives these yields. But remember, it fuels more spending and investments. So let's continue down the rabbit hole. So we got the catch. The Fed itself doesn't see that happening as fast as the market does. So the market sees that rates will drop more than the Fed is forecasting. Their dot plot, so this is the Fed's dot plot, puts the median expectation at about 3.4% by the end of next year, which is basically 2 fewer cuts than what Wall Street is pricing in. And this is where the risk comes in, because markets are already they've already started easing financial conditions based on those expectations. And if the Fed slows things down, if Powell says, wait, not so fast, y'all, we could see yields snap back and stocks stumble. And the reason stocks would stumble if we see these yields start snapping back is because yields impact the spending and the fuel of the economy. Like we were just saying, it fuels spending, because when yields go down, borrowing cost is cheaper and people have more money to spend. And if they're starting to expect that the future financial conditions will be more loose, it'll be a better time, they'll start spending money, and inflation could become this problem again, which is kind of why there's this discrepancy from where Wall Street sees us going versus the Fed's forecast, because they kind of want to have inflation in check, because like I just said, if people start expecting it to go a certain way, it almost self-fulfills itself out because of how people view it, how they start spending money. There's a whole psychology about how it goes down. But the split inside of the Fed is widening, though. So we don't even know if these Fed forecasts are legit, because we got Stephen Myron, the new governor, the Fed governor, and lone dissenter last week, what he wanted was a much larger cut, pushing for rates closer to this 2.5% level, arguing that current levels risk unnecessarily high layoffs and higher unemployment. He also echoed Trump in saying fiscal and immigration changes could dampen inflation, giving the Fed cover to cut faster and go much lower as far as their neutral rate. Also, we had Raphael Bostic out today, the Atlanta Fed president, and he's on the complete other side of the table. So they're just, imagine the two sit on each side of the table, like arguing in a way. So Bostic only penciled in one cut for all of 2025 and says inflation risks are still too high. So from his point of view, he's concerned about the inflation that has been too high for too long, for way too long in his point of view. So the market's lucky they got the cut they got, but he doesn't want to keep going forward because of the risk that it could have on inflation, which we just kind of talked about, that self-fulfillment. Once people start expecting things to go one way, they kind of do that as far as consumer spending goes. Then Alberto Mussolini from St. Louis, he's somewhere in the middle, so he's kind of like the guy trying to get both parties to see eye to eye. He's like, well, y'all, let's like, he sees points from both sides. So he's supportive of last week's rate cuts, but he's warning against going too far regarding these cuts. He sees policy as between modestly restrictive and neutral, and urged caution about making monetary policy overly accommodative. So the Fed's debate boils down to this. Do they keep leaning towards the job market, which is seen and expected to keep showing cracks and weakening as we head later on into this year? This next job report is going to be a big one that we're going to be watching. We're already expecting a much larger amount of jobs to be uncreated, because that's when this government severance thing ends, and a lot more people are going to be filing unemployment, so the jobless claims will be interesting. That next jobs report will be interesting. Or does the Fed just keep inflation front and center and keep their fight on going with that? So looking ahead, that brings us to the next big moment, which comes as early as tomorrow, and that is Jerome Powell's speech in Rhode Island. The market will dissect every single word for clues on how fast the Fed plans to cut, whether Powell sides with the cautious Bostic camp or the aggressive Myron camp, and ultimately how much of this rally is built on hope versus reality. Because right now, Wall Street believes it can have it could have its cake and eat it too. Lower rates, no recession, and AI-fueled growth, stocks to the moon. So history tells us that that's a dangerous game to bet on, to make without risks. So that leaves us here, everybody. And we got to ask ourselves this question honestly. Is this rally a real deal, or are investors setting themselves up for this disappointment if the Fed doesn't deliver? And let's think about in history, and with stocks at this valuation that they're at, how likely are they to give the green light for the rally to just keep on rallying? So if the Fed doesn't deliver, that could be seen as a huge, huge disappointment. But, there could be that green light. But today we got Nvidia and OpenAI. They may be building out the future, but the Fed still decides the cost of money today. So what do you think, everybody? Is the market right now front run the Fed, or is this optimism a little too far ahead of reality? So let me know what you think down in the comments below, everybody. Today was quite the show. That's all I got to say. And I bet tomorrow it won't fall any short of where we're at today. So every day we'll keep on coming back. We'll talk about what's happening, everybody. Hope your day's been awesome. I'll see you tomorrow.